What are the reporting requirements for USG? Have you ever wondered how companies report on their environmental, social, and governance practices? Understanding the reporting requirements for environmental, social, and governance reporting can be quite revealing, especially in the context of private equity and capitalism. Let's break it down. First, there are two main components to consider: framework requirements and data metrics requirements. Frameworks guide the structure and content of the USG report. They help companies decide what topics to cover and how to present their information. Some popular frameworks include the Global Reporting Initiative, the Sustainability Accounting Standards Board, and the Task Force on Climate-Related Financial Disclosures. Each framework has its own focus. For instance, the Sustainability Accounting Standards Board emphasizes industry-specific issues, while the Task Force on Climate-Related Financial Disclosures focuses on climate-related financial risks. Next, companies must disclose specific data metrics, often referred to as key performance indicators. These metrics measure a company's performance in various areas, such as greenhouse gas emissions, water usage, waste management, and workforce diversity. It is essential that these metrics are calculated according to recognized standards to ensure accuracy. For example, emissions data are typically reported following the Greenhouse Gas Protocol, which standardizes how to measure carbon footprints. In the realm of private equity, USG reporting presents unique challenges. General partners must provide both qualitative narratives and quantitative data that reflected their responsible investment approach. Unlike public companies, private equity firms often do not use broad corporate sustainability frameworks. Instead, they adopt sector-specific best practices tailored to their investment focus. This means they need to clearly articulate the material USG issues relevant to their portfolio and show how these considerations drive value creation and risk management. Investors, regulators, and other stakeholders increasingly demand transparent and comparable USG data. They want to assess how private equity firms manage climate impacts and social risks. Initiatives like the USG Data Convergence Initiative have emerged to standardize USG data collection and reporting in private markets. This addresses the historical difficulty of accessing consistent USG information. From a capitalism perspective, USG reporting requirements reflected the market's growing recognition that environmental and social factors influence investment value. Transparent USG disclosures enable investors to make informed decisions and allocate capital efficiently. While these requirements can add compliance costs, they also create opportunities for competitive advantage by signaling strong governance and long-term value creation. In summary, USG reporting requirements involve adhering to established frameworks for narrative and data disclosure, calculating key USG metrics according to accepted standards, and tailoring reports to the specific context of private equity portfolios. These requirements not only support market transparency but also help align investment practices with broader economic and societal goals.